the first half of 2024, the AI boom pushed US stocks sky. Nvidia surged, the Nasdaq kept climbing, and the S&P 500 rose nearly 15% in just 6 months. Jack's old friend Tom came over to brag. "Bro, I've been investing every week and caught several dips. Look at my returns now. I'm doing better than you. Right?" Tom wasn't wrong. In a one-way rising market, high frequency, dollar cost, averaging does let you get in earlier. Every pullback becomes an opportunity you catch. In the short term, those who invest weekly or daily accumulate more shares, and their performance curve looks better. But in the summer of 2024, the market suddenly turned. On August 5th, the Nikkei index plunged 12%. Global markets panicked, and the S&P 500 dropped 3% in a single day. Tom panicked. He began to question whether weekly investing was too aggressive and even considered stopping altogether. Jack, on the other hand, glanced at his account and kept investing. Short-term winners are often just riding the wind. When the market changes direction, the one who laughs last may not be the same person. By 2025, both Jack and Tom had stuck with their strategies for nearly 2 years. When they finally sat down and carefully reviewed their results, they noticed things they hadn't paid attention to before. The first cost: transaction costs. Tom invested weekly, making over 100 transactions in 2 years. Each one came with commissions and foreign exchange fees. Jack invested monthly, making only 24 transactions. Tom ended up paying nearly $300 more in friction costs. It's not a huge number, but small leaks sink ships. The second cost: attention cost. Tom checked the market every week. When prices dropped sharply, he would struggle over whether to buy more. His anxiety skyrocketed. He realized that this constant mental drain significantly reduced his enthusiasm for investing. Data shows that people who invest weekly are more likely to be influenced by short-term fluctuations, leading to emotional decisions. The third cost: mismatch costs. Tom's company paid him bi-weekly, but he invested weekly. He often faced situations where the money comes next week, but I need to invest this week. Meanwhile, Jack set his investment date to the day after payday, and his cash flow was never interrupted. By the end of 2025, Jack's account had a total return of 33%, while Tom's was only 28%. Jack invested monthly, Tom weekly. The harder working person didn't win. Stretch the timeline to 10 years. Backtesting data shows that the final return difference between weekly and monthly investing is usually within 1%. Over periods longer than 10 years, the difference does not exceed 5%. Why? Because the essence of dollar cost averaging is not catching every low point, but averaging your cost through long-term, staggered buying. Small differences in frequency are almost completely smoothed out over long time horizons. Take the S&P 500 as an example. Over the past 10 years, its annualized return has been about 14.11%. Whether you invest weekly or monthly, as long as you stay consistent, the final result is roughly the same. So stop obsessing over whether to invest daily, weekly, or monthly as long as you can stick with it. The results will be similar. Choose monthly if you get paid monthly, since it matches your cash flow. Choose weekly if your income comes weekly. As for daily investing, unless you're a full-time trader, forget it. It's exhausting, costly, and pointless. At this point, you might wonder, so is dollar cost averaging perfect? Not so fast. There's a major prerequisite: you must invest in assets that trend upward over the long term. I know an investor named Sarah from Chicago. In 2021, she followed advice from a finance influencer with millions of followers and started dollar cost averaging into several hot funds that had performed exceptionally well in previous years. When the market dropped, she kept buying more as prices fell, but her account never recovered. Eventually, she lost hope of breaking even and stopped investing, still sitting on nearly a 40% loss. If she had invested in a broad index like the S&P 500 instead of a basket of hype-driven funds, the outcome would have been completely different. Warren Buffett made it very clear in his will. After his death, 90% of his assets should be placed into low-cost index funds. Why? Because index funds represent the growth of the overall economy, not the luck of a single stock or fund manager. There are 2 more common traps in dollar cost averaging that many people fall into without realizing it. The first trap is stopping when it falls. Many people set up an investment plan, but when the market drops, they tell themselves, let's pause and wait for things to stabilize. This is exactly the biggest enemy of dollar-cost averaging, because the most profitable phase of DCA is when you're buying cheap shares during downturns. The moment you stop, you're giving away those low-cost opportunities. Backtests show that those who stop investing when the market drops more than 10% end up with returns more than 35%, lower than those who continue. The second trap is increasing when it rises. When the market climbs for 3 consecutive months and returns look great, some people get overconfident. They double their investment amount or even use money meant for living expenses to chase higher prices. When the market corrects, not only do they lose profits, but the oversized position causes psychological stress, often leading them to sell at the bottom. The essence of dollar-cost averaging is discipline, not market timing. No matter whether the market rises or falls, sticking to your plan is what allows compounding to work. There's an old saying in investing: time in the market is more important than timing the market. Dollar-cost averaging is not a scam. The real scam is people telling you that daily investing can easily beat the market. They ignore one key fact. Over a long enough time horizon, the frequency of investing has minimal impact on returns, while staying invested is the only factor that truly determines success. Tom later told Jack, "I finally understand. Watching charts every week wasn't investing, it was gambling. I thought I was optimizing, but I was just draining myself. If you want to go further on the path of wealth, remember Jack's approach. Set your amount, fix your date, close the app, and go live your life. The day after your monthly paycheck is your investment day. Automate the deduction end, then stop checking your account, because the market will always fluctuate. But what truly makes you money is not when you invest, it's whether you keep investing. 10 years later, when you look back, you'll realize that simple habit of investing every month on schedule is far more powerful than any perfect market timing. Have you ever hit a pitfall in regular investments? Was it choosing the wrong target, or panicking during a market drop? Or perhaps, like Tom, you've had the experience of the harder you try, the more anxious you get. Feel free to share your investment stories in the comments, whether you're a casual player investing once a month, or a diligent little bee watching the market weekly. Your experience might just help someone else who is struggling.